Okay, good afternoon, everyone. My name is Meredith Crowley, and it's my honor and pleasure to welcome you to this ESCoE Economic Measurement webinar. I'm one of the new topic leads at ESCoE, focusing on globalization, prices, and digitalization. And today it's my pleasure to introduce you to Professor Kim Ruhl of the University of Wisconsin at Madison. Kim holds the Mary Sue and Mike Shannon Distinguished Chair in Economics, and he is an international economist whose research focuses on understanding firm heterogeneity and national income accounting. Among his other honors, Kim is a research associate at the National Bureau of Economic Research in the United States, and he's also an associate editor at the Review of Economic Dynamics. And so without further ado, I'll turn off my mic and hand off to Kim.
Okay, great, Meredith. You can hear me okay?
Perfect.
Great, okay. Welcome everyone and good afternoon. Happy to be here virtually talking about offshore profit shifting. So let me just jump into it. Oh yeah, first of all, the disclaimer, we're going to work with confidential data collected from the Bureau of Economic Analysis. So everything we've done here has been done in a way that maintains the legal confidentiality of the data and the respondents. Okay, so I'm going to use some words like profit shifting, right? To use that to discuss ideas like that multinational enterprises, or MNEs, kind of by their very nature, have access to heterogeneous tax location. Right? They operate in different countries under different taxing jurisdictions. My focus today is going to be only on US MNEs, and there are some, obviously some sort of specifics to this particular firms, but that's the data we have. So I'll be thinking today kind of solely about US firms operating outside of the United States. So their access to heterogeneous tax locations creates an incentive to basically shift profit. And the idea being that you structure the firm or transactions within the firm so that profit is booked in low tax countries, minimizing the tax burden on the firm. I want to, I guess, stress that everything I'm talking about today is in terms of everything that are legal tax optimization strategies. There's nothing illegal here. This is all operating within the sort of legal structures of the countries. Just taking advantage of differences across jurisdictions. So there's a lot of different ways firms do this, but one popular method, and one that we're going to find a lot of support for in the data, is the idea that a multinational firm assigns its assets or sells its assets in some sense to a low tax country, and then profit accrues to those assets at low tax rates. So you can imagine a firm putting a piece of intellectual property, intangible capital is particularly well suited for this kind of idea. You put a patent, let's say, in your affiliate in Bermuda, and then when you sell something outside of the United States, part of those sales are getting paid as royalties, let's say, to that patent. So that's a way to make profit accrue to a low tax place without necessarily having a lot of actual production happening in that in that location. And so there's been a lot of work sort of thinking about this and worrying about this in terms of raising tax revenues, right? What it means for the United States IRS. I'm more concerned about what it means for measurement, right? So the idea that now the reported profit does not necessarily reflect economic activity. And so I kind of got into this project when I first started working with this data. And one of the first things that people at BEA told me was, well, you should just ignore all the data from, say, the Bahamas and Switzerland and maybe even Ireland, because the data all look funny because of all of this. And I sort of thought, well, this seems very interesting. Let's sort of see what's going on. And so this idea that we're breaking the link between kind of production and location of reported profits in the NEPAs is something that we've been wanting to address. So here's this is just using aggregate data to give you a sense of what this looks like. This idea that these multinational firms are amassing assets basically in low tax locations. So what this table is showing you here is, we'll just maybe just look at the first column, let's say. So this is the total of all the US foreign-owned affiliates assets, right? So this is, for example, look at the row that says Canada. That's all the assets, both financial assets, non-financial assets owned by U.S. multinationals located in Canada, divided by the value of all of their productive capital, their plant, property, and equipment. And so that's a ratio of about 6. We don't think of Canada as being particularly a tax haven. And we move to countries like Ireland or Luxembourg is quite an outlier. These numbers jump up quite a bit. There's just a lot more assets relative to PPE, or in the other columns, you can see this is relative to compensation or even employment in these European tax havens. And then below that, the set of countries, the kind of Caribbean tax havens, and then the Asian tax havens. So even from the aggregate data, we can see there seems to be a lot of assets piling up in these tax haven countries, and we'll see that often this is something as part of a tax avoidance strategy. Okay, so then the question that we're after today is, so let's imagine that there's this US firm and it's created a patent. Most patenting and most research is done still inside of the parent. So in this case, you think about research being done in the United States. So this is maybe a corporation in Silicon Valley creating a new patent. If that patent is still held by the United States parent, then any payments on that patent, any royalties on that patent, would then be booked into the United States and the parent, and it would show up in US GDP. It's the return on the investment made by that firm in the United States. So you'd have a flow of payments into the United States, and then you need to have a counterflow so that all the accounts balance. And so the counterflow would be an export of services from the United States. It's a service of intellectual property in exchange for payment. And so that's what it would look like if all these US firms were still held on to their intangible capital. If instead that intangible capital is moved offshore and held by a foreign affiliate, then the payment for that into intellectual capital or intangible capital is booked into the affiliate. That shows up in income on US direct investment abroad. Right? And US direct investment abroad income is not a part of US GDP. It's a part of GNP, right? So just this is probably the audience that needs this the least is just GDP plus the income on US direct investment abroad and some other things make up GNP, right? And so by moving intellectual property offshore, we're changing sort of the way we measure GDP within the United States. And so what you can see when we look at US direct investment abroad income on US direct investment abroad, we see that starting in around the late 1990s, early 2000s, this kind of explodes. Right? There's a more or less quadruples in about 15 years. So it's this big, increase in U.S. Direct investment abroad income. And then the question is kind of how much of that income is sort of the result of profit shifting that would have been instead income to the parent and part of U.S. gross domestic product. So the idea of what we want to do today is try to exactly kind of answer that question. So what we're going to do is reapportion income across parts of a multinational. What that's going to do, what we're going to find is what it's going to do is going to decrease income on U.S. direct investment abroad, increase GDP, and so it's going to change a bit on how we measure things in the United States. Note it's going to leave GNP unchanged, kind of by construction. We're thinking about the kind of the domestic part of it, and so GDP is sort of our variable of interest. Okay, as I mentioned before, we're going to focus on U.S. multinationals operating abroad because that's where we have the best data. So as just a preview, this is kind of the number that we're going to generate. So the black line is what I showed you before, income on U.S. direct investment. The blue line is what we've determined is the part of that income that would be reappropriated to the United States, and so that's about a third on average. About a third of U.S. direct investment abroad income are the result of this profit shifting. Notice that, and we'll talk a bit more about the shape, but one of the strengths of this data is that we can construct a time series of this variable compared to some other studies, and we see that it kind of grew with FDI income in the early 2000s, but it's since kind of tapered off since 2010 or so was sort of the peak of this, and then it started to recede. So in the aggregate, the adjustment from our data started about 1982. From 82 to 2000, it adds more or less nothing. It's fairly small. From 2000 to 2016, our measurement would say that US GDP should be about $2.1 trillion larger than reported in official statistics. And it sort of reaches its peak in 2010 when we would reattribute $190 billion to the United States. And that works out to be about 1.5% of business sector value added. So the numbers can be fairly large. Now, what I'll show you later is that this is not kind of uniformly spread across the economy, and in particular, the firms who seem to be most engaged in this work in what we're going to call R&D intensive industries, and we see that as partially as support for this idea that it's intellectual property or intangible property that makes it easiest to kind of do some of these profit shifting strategies, particularly the ones that involve kind of moving some assets to countries where we're not actually doing any production or sales. So for these industries, the R&D intensive industries, the adjustment can be as big as 7% of the industry's value added. So we could be, compared to official statistics, the output of these industries might be 7% larger than we're measuring. Then, because I'm interested in measurement, I want to go back then and think about what this implies for some other things that we measure in the economy. Since we're changing our measure of GDP and we're not changing our measure of labor, that has some implications for productivity. And we'll see that kind of sometimes that makes productivity grow faster than in official statistics and sometimes makes it grow slower. So we'll walk through that. All of this kind of missing income in our accounting is corporate profits. So that suggests that the labor share of income is lower than we measure in official statistics. The return on foreign direct investment abroad falls in a somewhat dramatic way, and the trade deficit is smaller than measured in official data. So I'll walk through kind of those measurements. Okay, so let me just kind of jump into what we're going to do, and then I'll get to the measurement implications. So the data from the BEA surveys, which are mandatory surveys relative to some cutoff on firm size, we collect data on both the parent, the U.S. multinational parent, and their affiliates abroad. And one of the nice things about this data is we get to see, the firms, we get to see where the affiliates are located and kind of then various statistics about the firms. So let's say there's capital M multinational enterprises in the U.S. multinationals, and then each one of them we'll make this normalization that n equal to 1 is the parent, and then 2 through NM foreign affiliates. And so there's a lot of heterogeneity in the number of affiliates in the data, but that's sort of going to be our structure. We have a multinational parent and then their foreign affiliates. And then this is just a kind of graphic representation of sort of what we're doing. And then I'll show you an equation in a second. But imagine this is the kind of data that we can see. So this is a hypothetical firm. So there's a US parent, and then I'm thinking about kind of 3 foreign affiliates operating in different countries that have potentially different tax systems. Okay, the type of data that we can see. So first we can see a measure of profit. So that's going to be important, obviously, for what we're doing. So those are the red circles, and then the black circles are one of the variables that we can observe. For example, like is the wage bill. And so the thing about wage bill is telling me something about how much real activity is happening at that location. And so if we look across the foreign affiliates, we can see, for example, foreign affiliate 1, there seems to be a lot of real activity happening, a large wage bill, but very small reported profits. And then the foreign affiliate number 3 is reporting a lot of profits, but is employing very few people or paying not very many wages. And then foreign affiliate 2, this is sort of like a Goldilocks. Foreign affiliate 2 is kind of their profits seem to be proportional to their wage bill. So what we're going to do is basically reattribute the profits within the firm. So we're not creating or destroying profits here. We're just within each multinational. We're going to reattribute profits across the entities within the firm, proportional to things that we can observe that that tell us something about production costs. So wage bill is an example, but we'll do other ones as well. And so what we do then, this is the thing about the dotted lines, are now how we're going to change the reported, how we're going to change reported profits to what we think are sort of, in some sense, true profits. And so the foreign affiliate in country 1, we're going to increase the amount of profits sort of attributed to that location. In foreign affiliate 3, we're going to decrease the profits to the point where they're proportional with the wage bill. And then after kind of doing all these attributions across the foreign affiliates, the kind of residual of that ends up being reattributed to the parent. So in this case, the parent's profits grow a little bit and are now proportional to their wage bill. Right? So that's sort of visually, that's kind of what we're after. We're setting up. So within each multinational, we're doing this. So there's no moving profits across firms. It's all within the firm. Now, this proportionality assumption, this proportionality kind of methodology kind of naturally comes out of optimization problems from firms. So if you have a constant returns to scale production function, then the idea that profits are proportional to factor payments just sort of naturally follows from an optimization problem. So what we're going to do then is consider 3 different factor payments. The wage bill, which we talked about before, the rental payment, payments to capital, and then these are payments to intangible capital, so to R&D. Right? And so what we can show, and we show in the paper, is that each one of these terms should be identical, right? It should, if a firm's optimizing, it should be then that the share of that firm's payments to labor relative to all the payments in the firm, right, should give me that firm's share of total profits within the firm. That's what we're going to do, because obviously not all of our assumptions are ever exactly true, and there's measurement error and other things. We're going to just take a weighted average of the 3 measures of production costs we have in our data: wages, capital payments, and R&D payments, and kind of average those 3 terms to come up with our weight for each particular part of the firm. So then, using these weights, we're just going to apply for each firm, N in multinational M. That weight just determines what share of total profit that firm is, we attribute to that firm. Okay, so basically we're taking this weighted average of production costs in each member of the firm, and then we're using that share to reappropriate profits across firms, right? So that's kind of what we were doing here. This is the sort of visual representation of that. And then we'll talk about the adjustment. What we call the adjustment is just simply the reappropriated profit, right? So what we think that particular member N in firm M as profit should be minus their reported profit, right? So this is what they report. This is what we've attributed to them, and the difference we're calling the adjustment. So the adjustment is just the difference between the attributed profit to that firm and the reported profit. Now we're going to I'm going to basically just only talk about the adjustment here that's going towards the parent, right? That's sort of the U.S., the adjustment to the U.S., but this implies adjustment to all of the firms across across the world, and I'll talk a little bit about that. But our main focus here is on the adjustment to the U.S. So just a quick note about kind of what we're doing and how it might compare to other approaches you might think to do. So as I mentioned before, our approach, sort of the methodology, looks like a proportionality kind of method. And the assumption here is that the factor shares in that production function and that markups are the same within the multinational. Right? That's kind of, if that's true, if those things are true, then we exactly recover what we want to recover. Obviously, as those things differ, we're going to have there's going to be some differences, but that's sort of the platonic kind of ideal. What doesn't have to be true, it doesn't have to be common in our framework, is factor prices don't have to be different or don't have to be the same. So the fact that you may be operating in a low wage place and a high wage place, that's fine. That this is all goes through for that. Productivity differences across units within the multinational is fine, given what we're doing. So this kind of allows for a lot of flexibility in that sense. It certainly allows that the profit function can be different between multinationals. And so there's nothing that says 2 multinationals have to be structured the same way. And the profit functions can also change over time. So we're not imposing any structure on that. So As usual, you have to make some assumptions that may not be palatable, but then on the other hand, we're kind of getting a lot of flexibility out of this. We can handle lots of different differences across firms and across time. An alternative approach, which we've explored a bit, would be something more structural. So now it's assuming a functional form and then trying to estimate a profit function using observables. Again, you're going to need some assumptions for identification. Something like maybe restricting coefficients across industries. That kind of comes with its own set of issues, and but that might be another way to go about doing this. Certainly a more data intensive way to do it. Okay, so let me tell you then a little bit about the adjustment and what it looks like, and then we'll go on to think about its measurement issues. So here's the adjustment again. This is what I showed you earlier. This is U.S. direct investment abroad, income. The blue line is our weighted adjustments. That's the one using the wage bill, capital payments, and R&D payments, so I'm calling that the weighted adjustment. And then this, just to give you a sense of the variability of this, the two black dashed lines are the 25 and 75th percentiles, and then the gray band is the plus and minus 2 standard deviation band. So there's some variation around this, but this is pretty well estimated. Here's each one of the components separately. So again, the blue line is the weighted measurement, where I take into account all three of the measures. The black line is if I only use plant, property, and equipment to estimate the to estimate the adjustment. The red line is if I only use compensation, wage bill, to estimate the adjustment, and the green line is if I only use R&D expenditures to estimate the adjustment. And as is kind of well known, most R&D is done in parents. That's starting to change a bit now, but historically most R&D has been done inside of parents. And so the green line sort of would suggest an even larger appropriation back towards attribution back towards the United States in this case. But this gives you just a sense of how those different measures kind of relate to each other. Okay, so if you look at the timing of this, we'll go back now. If you look at the timing of this, you'll see that basically the kind of share of profit shifting starts to grow in the late 1990s. And so it starts to level off around 2010. Thinking about sort of what factors might be driving the timing of this, because like I mentioned earlier, one of the strengths of what we're doing is we can see the time series. I'm not going to go into this today in today's talk for brevity, but you can see in the paper we talked about this sort of lines up well, kind of first and foremost with tax law and regulation. So it was in the early 90s when a lot of the profit shifting strategies kind of really became popular, and it was around 2011 that the U.S. government and the IRS started kind of enforcing or implementing some rules that made it harder to do this cost sharing of intellectual property outside of the United States. There's also some effect from petroleum prices and exchange rates, right? And the idea that sometimes there's just more profit that can be shifted than in other cases. A quick comparison of what we're doing to some other papers in the literature. The paper kind of closest to us in terms of approach and kind of methodology. This paper by Torslav, Weyer, and Zuckman. They're doing basically a cross-section. Originally a cross-section in 2015. They've expanded a bit since then. So they're looking at aggregate data, which lets them kind of look at profit shifting in many different countries. But then with the kind of drawback that they're kind of restricted to looking at cross sections. The original work shows in 2015. So comparing their number for the United States with ours, they find about $143 billion in 2015 versus our $158 billion. So pretty close, given that we're using entirely different data sets, similar methodologies, but different data sets. So that's I think a nice robustness check on both of our works, that we're finding numbers that are pretty close to each other. A second kind of well-known paper by Kim Klossing basically takes estimates of the elasticity of profit shifting to tax differentials. So basically, estimates a set of parameters that says conditional on or given a differential in taxes across countries, how much profit do we expect to see shifted? And then she basically takes the given tax system and says, if we harmonize taxes, so if we say now we get rid of all differences across countries, and then she does a calculation of how much profit difference there is. Her number is a bit larger than ours, 258 billion. This is for 2012 versus our 144 billion. But that's kind of using, again, a fairly different approach. Okay, looking now to the adjustment by industry, you see that most of our adjustment, so that's the first column here, is like this is for 2012, a representative year. We're just asking of that total adjustment, the $150 billion, how much of it is falling into different industries. So this is fairly aggregated for disclosure reasons, but we can see that the types of industries where this is happening are ones that seem to be the ones with a lot of intellectual property and intangible capital. So the biggest sort of user of this is manufacturing, including things like computer manufacturing, electronic equipment manufacturing. In industry 32, which looks a bit less high tech, inside of the chemical part of this industry is pharmaceuticals. So if you've opened a newspaper in the last few years, you'd see that pharmaceutical companies are very well structured for doing this. It's a pharmaceutical company is basically a giant intellectual property company, and once you have that patent, the actual marginal cost of production is quite small. And so we see that this industry seems to be responsible for a lot of profit shifting as well. And then we see things like computer system designs. I think about computer software companies and data processing. And maybe just as interesting as we get to the bottom of the table is we're seeing things like retail trade, arts and recreation, hotels, accommodation, education, a lot of kind of service-based industries in which it seems like just sort of a priori, it might be a lot harder to disassociate the actual physical location of production with some kind of intellectual property. It's might be hard to say that I'm building a bridge in Mexico, but somehow I'm earning all of my profits in Bermuda. So we'll talk a bit more. Break these things out a bit more by R&D intensity in a moment. But it seems like just looking at the data by just a broad industry that seems to line up with this idea that it's kind of firms with more intellectual capital make it easier to use these strategies. So this is kind of a way to think about. Like I said, I'm mostly focused on what's happening within the United States, but we can say some things about what's going on in other countries. So this is also for 2012, and this is a look at the geography of this. So in 2012, we computed a $140 billion reattribution of profits to the United States. And since all we're doing is reattributing profits, we're not creating or destroying any profits, those had to come from somewhere. And so looking across which countries then have decreases in profits of their U.S. multinationals, again, we see some fairly sensible numbers. So these are the top seven firms, or the top seven countries, and you see the largest one is Netherlands, and then very close to it is Ireland. And there's this very famous double Irish with the Dutch sandwich kind of profit shifting strategy that involves corporations in Ireland and Netherlands as a way to move profits roughly tax free out of those sales. We also see countries like Luxembourg, Switzerland, Bermuda. The Cayman Islands are here in this United Kingdom island Caribbean. That's the Cayman Islands are there, and Singapore in Asia. Right, so these are all the countries that we generally think about as being tax havens, and that they say come through in our data. And maybe it's worth stressing that as I walked you through what our methodology looks like, nothing in our methodology used anything about tax rates. Right? We never used a tax rate to try to determine the extent of profit shifting. This is all just done from basically first order conditions off of a firm's optimization problem. So the fact that the biggest countries that we find as profit shifters turn out to be the ones that are largely thought about as being tax havens seems to lend some credibility to what it is we're doing. Okay, so that's sort of the extent of this aggregate adjustment. Now I'd like to show you some of the implications of this for measurement, because that's sort of what we were interested in. So just to think about how we're going to do this. So again, remember this epsilon M1. This is the adjustment for the multinational parent, right? So this is how much more or less. For some firms, it's less, but how much more or less profit are we attributing to the U.S. multinational parent at time t? So what we're going to do, we're just going to add that then to reported value added in the United States. This is from the official statistics. Deflate it by a GDP deflator, and so we're going to call that thing, Y with a tilde value added. So that's our adjusted measure of value added. So that's our new measure of that. And then we'll start by thinking about maybe just productivity. And so productivity, to follow some of the literature on the productivity slowdown, we'll measure just value added per worker. And so, we're adjusting the numerator, but we're not doing anything with the denominator. So that's going to kind of be how our adjustment is moving through the national accounts, is typically through a change in our measure of value add. So this is what the two series look like. So the black line is the official measure of value added per worker in the US, and the blue line is the our adjusted measure of value added per worker in the US. The two vertical lines are showing the period that most people think of as being, when productivity, the sort of high productivity growth period in the U.S., and then post 2004 being the slowdown in the U.S. I'm just going to, you can see from this that this adjustment doesn't do much until 2005 or so. So what I'm going to do is then just difference these two lines, show the difference of them, so you can get a better sense of kind of what's happening. So this is the difference between the two. So you read this line as being the increase in labor productivity growth that comes from profit shifting. And you can see it reaches its peak around 2010, adding about 1.2 cumulative points to productivity growth. But then as profit shifting starts to decline, so does the boost to productivity. And in fact, by the end of the period, it's basically a wash, right? That by 2004 and 2016, that increase in productivity has basically now been undone by the decrease, and the effect on profit shifting has changed. So it takes me a long time to write papers. When I first started writing this paper, the last year data we had was 2011, and so it looked like productivity was growing as a result of profit shifting. And then as if taken me forever to write this paper, now we can get to see this kind of very interesting decline as well. So we're sort of seeing the rise and fall of kind of profit shifting growth, at least in the United States firms. Okay, so now I would like to take those and again look at the industry characteristics. All right, so that's in the aggregate, and so but in the aggregate we've kind of already seen that this is sort of concentrated in a few industries. So after doing lots of different things, including checking stuff like IT using firms versus IT producing firms, which has been talked about in the literature a bit, I'm going to show you the results for R&D intensity. So basically, we can take the firms and rank them by their R&D intensity, and we're going to call R&D intense firms, excuse me, those in the 75th percentile by their R&D to sales ratios. And then we're going to compute the adjustments just like before, and kind of compute a value added, an adjusted value added, but now by kind of industries where industries are either R&D intensive or not. And so now this is the result of that. So this is the adjustment, right? So this is how much income are we reattributing to these sectors. And I'm doing this as a share of the sector's value added to give you some scale. So for the R&D intensive industries, we see that this reaches its peak in 2008 of almost 7% of industry's value added, right? So we're saying that in 2008 we were missing about 7% of the value added in these industries, and that's again has sort of tapered off a bit since then, but it's still roughly at about 4% by 2016. And you can see compared to the non-R&D intensive firms, right? Basically very little is happening here. is roughly flat. There's a bit of a bump around 2010, but it never reaches more than 1%. So this, I think, gives you a good sense of how concentrated profit shifting is in certain types of firms, and in this case, in firms that seem to be investing a lot in R&D, presumably generating this kind of intangible capital that makes it easier to shift profits across firms. This is productivity across these firms. Again, this is, we're at its peak, it's almost a 5 percentage point difference in measured productivity in the official statistics versus the adjusted statistics, and the non-R&D sort of tracks the adjustment as well. That we don't seem to be mismeasuring R&D intensive firm productivity as much as the R&D intensive firms. Okay, so then moving on from productivity, you can think about the labor share. So the income that we're reattributing to firms in the United States is corporate profit. So that's which we consider to be capital income. So we can think about then what that implies for the labor share, just thinking about sort of the simplest version of the labor share here, which is just basically the wage bill divided by output. We're not changing the wage bill; that's sort of staying the same, but we're adding, income to the denominator, right? So capital income in particular. And so this is sort of what the dynamics of the labor share look like, and so that's sort of lower than in the official statistics, and then it falls a bit more in the later period than before. So there's been a lot of sort of discussion and debate about what's happened to the labor share. You can see it's kind of falling from 0.64 or so at the beginning of the century, down to almost 0.55 by the end of our time period, and basically our adjustment is just sort of making all this a bit worse. So if you think that the labor share is kind of falling, our numbers sort of suggest that it's fallen to levels even lower than that. So off by about a percent by the time we're done. So now moving on to direct investment. So this is someplace where this kind of a calculation is going to have a lot of bite. So there's been a kind of FDI return puzzle, I guess people have talked about in the literature, which just sort of says that US multinationals persistently earn better returns on their foreign direct investment abroad, right? So a US company has a higher return on their foreign investment than a foreign company has on their return in the United States, right? So GM operating a plant in Mexico earns a higher return than Toyota does operating a plant in the United States. That's just an example. I don't know if that's actually true or not, but that's the idea. So on the average, that's true. And so there's been a lot of theories about this, that U.S. firms operating abroad, there's less competition there. Competition is more stiff in the United States. That's riskier to go abroad, so you need higher rates of return. There's some sort of unmeasured factor, some kind of dark matter people have talked about. So all these kinds of ideas. Our idea is kind of much simpler, which is just U.S. firms would like to earn a lot of profits outside of the United States because those are low tax places. And foreign firms would like to not earn very many profits inside the United States because that's a high tax place. To the extent that you can shift profits outside of the US, everybody would like to do so. So we're going to then kind of take this on. So we're going to compute the return on direct investment abroad. So this is just investment income, US direct investment abroad income is the numerator. The denominator is the capital stock, and we'll just take the average of the capital stocks at the beginning and end of the period. In work that we're trying to do right now, we're actually trying to adjust the stocks of capital as well. So part of the construction of FDI stocks is looking at reinvested earnings. And so our adjustment should say something about that as well. That's been a little trickier to do. So for what I'm going to show you today, I'm only adjusting the numerator and kind of not the denominator. So to give you a sense of the aggregate numbers, so if we just look at the first column here, official, so 11.7%, that's the average return on US foreign direct investment abroad. Right, so that's from 1982 to 2016. That's the 11.7%. The return on foreign direct investment inside the United States is about 5%. And so it's that difference, the difference between almost 12 and almost 5, is that kind of return puzzle people have talked about, and that's been a persistent kind of difference over time. Now, unfortunately, in the adjusted column, we can't do an adjustment, at least not right now, on the foreign direct investment into the United States. We don't have enough data on what's going on in these foreign firms outside of the US, right? The BEA can get a US firm to tell it a lot about what it's doing. It kind of collects less data from foreign owned firms, but we can do the adjustment at least for the US data, the US firms. We said it falls from about 12% to about 7%. And so we're getting closer now to kind of closing this gap of the two. So let me show you the picture here. So the two black lines are the official statistics, the unadjusted return on direct investment abroad and return on direct investment in the US. And then the blue line is our adjusted measure of US direct investment abroad rates of return. And so in the earlier part of the sample, the blue line kind of comes down quite a bit, and there's still a fairly large gap between the two. By the end of the sample, the blue line is actually fairly close to the black line, the unadjusted direct investment in the US return, suggesting that the returns are, once we've adjusted for profit sharing, the returns are getting kind of closer to each other. The caveat here is that we'd need to make an adjustment, presumably to the return on direct investment in the US as well, which we can't do, which actually might likely, if we think that there's profit shifting out of the US, might even increase the rate of return on investments in the US, maybe bringing those two lines even closer to each other. But as of now, we've done some preliminary experiments trying to bring in data from other data sets to try to do this, but we don't have anything that we feel comfortable kind of showing anybody yet. Now, there's something a bit subtle though about this, which is that once we take direct investment abroad and we break it across tax havens and non-tax havens, we sort of see though a pretty big difference. So if we look at the solid line here in red, this is the unadjusted rate, or the official rate of return in tax haven countries. We see that's even higher than the unadjusted return in non-tax havens. That's the black solid line. Now, so the two solid lines are the official data. Maybe not surprisingly, in tax havens, the unadjusted rate of return is even higher than in non-tax havens. Then once we make our adjustment, that's the two dotted lines. So if you look at the red dashed line here, you see that the rate of return in tax havens falls dramatically. It falls from, in 2016, it falls from almost 10%, to about 3%. And so the rate of return in tax havens kind of really falls quite a bit, and is driving a lot of that aggregate change in the rate of return. And then for the non-tax havens, these things don't change very much, right? It's fairly similar to each other. And so suggesting there's still kind of a bit of a nuanced take on this rate of return puzzle, in the sense that the aggregate numbers here are being driven largely by what's happening in tax havens. But if you compare the sort of non-tax haven rate of returns against the US rate of return, which is, again, probably not considered a tax haven country, there's still a differential. And so there's still kind of something to sort of sort out, in the sense of why is it that in non-tax haven countries, US firms still seem to do better than their foreign counterparts investing in the US. Right? So this is kind of being driven largely by the behavior in tax havens. Then the last thing I'd like to show you is the trade deficit. So, again, our adjustment applies that for every dollar we reattribute to the United States, that should be matched by an outflow, right? This is like, just a balance of payments sort of logic. And so that outflow is what we're booking it as basically an export of intangible capital services. So this is the only place where, in our setup, it matters how the firm is doing profit shifting. Everything else, all the numbers I've shown you, all the stuff I've shown you up till now, is all agnostic to exactly how the firms are doing their profit shifting. This is the first place where we now need to make an assumption on what it is that the firm was doing. And so we're making this assumption that firms are using basically intangible capital to shift profits. So that implies then that the counter entry is an export of intangible capital services. So it has to be an export of something. We're just saying it's an export of intangible capital services. And so That means that there's a bunch of exports that we're not accounting for in the data, in the official statistics. And this is kind of what it looks like. So again, the black line are the official statistics. This is a trade balance as a share of GDP in the US. And then the blue line is our adjusted trade balance. And so, by 2016, the adjusted trade balance is about 1% of GDP smaller than it would be in the official statistics. So basically, there's some mismeasured or unmeasured exports of services that were created in the United States through this intangible capital that would showing up here. So again, here's this assumption that we're making about exactly what firms were doing. By construction, the goods trade balance doesn't change. That's still persistently negative. So what we're doing is basically adjusting the services balance. So it looks like the U.S. is exporting even more services than they were before. Right? So this is the sort of picture where if you think firms are doing something different, if you think that they're shifting profits through transfer pricing of goods or something like that, then that might change the goods trade balance relative to the services trade balance, but the total trade balance would still change by the same. It's just how you allocate that change across goods and services depends on kind of what you think the firms who are profit shifting are capturing. Okay, so yeah, good. I'm on time, I think. So just to conclude, so we've kind of constructed this adjustment that's robust to a lot of things and based roughly, basically just based on optimization characteristics of the firm. From 82 to 2016, it's about $2 trillion of GDP that we're reattributing back to the United States. Reaches its peak in 2010. Oops, I should say 2010, not 2008. It's at about 1.5% of business sector value added. But most of that is happening in just a handful of industries, and we find that there tend to be the industries that are R&D intensive, and that this adjustment for these firms can be as much as 7% of industry value added. And then, kind of talking through the measurement effects relative to official statistics, there's a small and kind of time varying effect on productivity. Labor share of income is smaller than we thought it was. The return on FDI, I think, is one of the most interesting results here. Kind of falls quite a bit on outbound FDI, and then, as I just showed you, the trade deficit shrinks. So I think that's sort of the time that I was allotted for this, and so now we'll open up for questions.
Thanks, Kim. That was a fantastic presentation, and you hit the time perfectly. But we've got the questions are flying in. So we'll start hopefully by unmuting Simon Van Norden. And Simon, if you'd like to ask Kim your question out loud. You a second.
Thanks, Meredith. Lovely paper, very interesting. I'm just wondering, is there any way that you can use the time series of data on international transfers of intangible capital to try to identify times when it appears that a large amount of intellectual property has been transferred to a foreign affiliate, and then from that point onwards, try to reallocate some of that value added to the U.S. parent?
Yeah, so that's a good question, and something we've thought about a little bit, but haven't made much progress on. We do see some of this. We can see some of this in the data, and then we can also see we have some data on royalty payments and things like this. So one of the things that would be interesting, and we've thought about doing, is kind of what you're similar to what you're saying is look for times when there was some transfers of these things, and then since we've seen this kind of what we have sort of a growing and then shrinking of this profit shifting. Try to see are there times when we see a lot of intellectual property or intangible property kind of transferred, and then there seems to be a flow of a large flow of payments to that to that affiliate that has this property, versus times when we see a transfer of intellectual property but don't see or see less of that, and try to use that as a way to sort of think about the way it might be changing over time, how firms are taking advantage of using intellectual property to kind of shift profits. So that is something that is an interesting part of the data that we have. The idea that we kind of have the time series here, and so that would be something, or is something, that we've kind of been trying to get at, but so far don't really have anything to show you.
Okay, thanks for that. So next up, David Byrne, would you please unmute yourself and ask your question? I'll give you a second, David. Okay, well, how about, maybe David has having some trouble with his microphone. I'll read the question he typed in, Kim. So David asks, Fernald and others have used the existing slowdown timing to cast doubt on the theory that the slowdown is tied to the global financial crisis. Your results push the contour of the slowdown forward, perhaps roughly to the timing of the global financial crisis. Is the reversion of the productivity adjustment connected to the global financial crisis, or is the timing just a coincidence? Yeah,
it's an interesting question, and I've seen some of David's work on this. This is one of the things that really got us started thinking about this project was productivity. And yeah, it's true. Just looking at a picture like this is very suggestive that once you adjust for profit shifting, the kind of trajectory does, and it certainly doesn't reverse the slowdown, but it certainly sort of chips away at it a bit. And then the financial crisis comes, and 2010 is sort of the peak of this, and things start to shift away. We've done some kind of structural break tests in the past on this to see if in the adjusted data you can find a kind of structural break for when for the slowdown kind of pushing out a bit further. Those tend to not have enough power to sort of suggest it's statistically, different than 2004. But it does seem that this kind of does seem to kind of get pushed a little further towards 2010, and then starts to taper off again after 2010. So it seems kind of suggestive, but we don't have any sort of smoking gun or anything to kind of say for sure that's the case. But it certainly is an interesting aspect of the time series. Yeah.
Okay. So thanks a lot. And so next, could I ask Rutger Hoekstra? Rutger, if you could unmute yourself to ask your question.
Yeah, hi. Thanks a lot for this presentation. I guess my previous understanding was that basically there was transfer pricing going on, and you pinpoint basically, I guess, the royalty payments within the M&Es. So, does that make the other transfer pricing on other goods and services unimportant? And is that perhaps through the OECD guidelines? And also, just from a policy perspective, how could you actually, I guess, regulate these kind of intellectual property rights transfers, so to speak?
Yeah, sure. So I didn't spend a lot of time talking about it today, but there are several ways firms can do this profit shifting, and you sort of just mentioned one of them, basically transfer pricing of goods. So, and within firm transaction are notoriously sort of hard to price because a lot of these things don't have a market equivalent. And so firms kind of try to decide how much a good is worth when it's being transferred across units within the firm. And so that, again, creates an opportunity by changing the way prices are, right? You want to make it look like the price is really high in the place that has high taxes and low in the place that has low taxes. That's a way in which transfer pricing can work. That is something that I think the IRS and OECD has had spent more time just kind of historically thinking about. There's kind of large transfer pricing divisions at consulting firms, and there is still some transfer pricing that goes on there. Maybe the other version of transfer pricing that I've seen kind of more recently being a big issue is basically transfer pricing of intra-firm loans. So basically the changing the interest rate on loans across units of the firm. And I remember back in, I believe it was 2017, one of the large oil companies got into trouble with the Australian government for doing exactly this, making loans to its Australian affiliates at largely different interest rates in ways to shift profits out of Australia and avoid paying taxes in Australia. And so there definitely are other ways that that this happens. And so really until we got to the trade balance sort of results, if they're doing it through transfer pricing, or they're doing it through intercompany loans, we should still be kind of picking it up, because nothing in our approach kind of made use of what the method was of transfer pricing until we got to the end and we needed to decide what the counter entry was against the profit. There has been a lot of discussion lately in the last 5 years or so about exactly dealing with intellectual property and kind of how to try to police this across countries. The European Union competition committee. You guys know better than me. Has had a lot of interest in this, because this is exactly driving this kind of race to the bottom behavior amongst EU countries. And so Luxembourg, for example, has had some problems with Amazon housing their digital services in Luxembourg and selling across the EU, but collecting kind of all of these payments as payments to their intellectual capital sitting in Luxembourg. Ireland, of course, is also kind of been a center of some of this. So there have been movements towards this. The agreement on the potential agreement on a minimum tax rate across countries that is trying to be negotiated now is maybe in some ways a way around some of that. So rather than trying to police that kind of behavior, just an attempt to kind of put a bottom on tax rates, so it makes this sort of less of an advantageous thing to do, would be another approach to this. Right? There's no difference in tax rates. There's a lot less incentive to do this profit shifting.
So thanks. And so I guess at the moment we don't have other questions from the audience. So I'll use my chair's hat to, so Margaret's coming up with one. Okay, so Margaret McAvoy, would you please unmute yourself and ask him?
Right. Have you got me?
Yeah, we can hear you.
Howdy. Hi, Margaret.
Right. Very, very interesting presentation and analysis. It's really fascinating, actually. But I just wonder, I mean, from just looking at it in another ways, is your analysis not somewhat theoretical? Because if profits were to be allocated back to the US in practice, some of the profits would be taken by government because the tax rates would be higher, I guess. And that also applies when you harmonize tax rates around the 15% or whatever it is that we're thinking about. But there'd be less then reinvested in research and development. So probably research and development might fall. What do you think of that?
Yeah, what you're saying is exactly correct. And yes, let me be clear, because some other people have sort of pushed me around about this. Not suggesting you're pushing me around, have pushed me on this topic too. That this is in some sense not a good. It's not like a counterfactual exercise of what would happen if tax rates were harmonized. You're exactly right that there's all sorts of incentives then once you change tax rates for this. And so, I mean, one way to look at what tax shifting is doing for U.S. multinationals is it's basically lowering the tax rate or raising the rate of return on their R&D investments, which I think is sort of what you were pointing out. And so if I'm a firm in California, I know that if I can generate the next iPhone or something like that, I get to earn a much lower tax rate on my global sales than I would have earned if I couldn't do this profit shifting. And so, yeah, this is in some way, if it is happening through this intellectual property, this kind of tax shifting is a subsidy towards doing investment in these things, right? And so, if you're a firm that can take advantage of that, you're a firm in an industry that kind of runs on intellectual property. This has been good for you. As you sort of saw, if you're in the construction industry or the education industry, you don't get to take advantage of this as well. So presumably, as you shut down, you'd think then the natural conclusion would be as you shut down profit shifting, as you harmonize taxes, things like harmonize taxes in the sense of increasing them, that would be a disincentive towards making investments in these things. You're exactly right, and we're not making any. Well, we can't without doing something even more theoretical and writing down models with optimizing firms who are making decisions about R&D. We don't have anything very good to say about that. That's a great point.
Thanks very much. So I'll maybe just wrap up with one question I had was when you first showed us the proportionality equation, there's, a third of the weight is ascribed to the wage bill, a third to the, capital returns.
Yeah.
And then I guess the last one is material goods or something. And I was just wondering if we're in a world where we've got rapid technological progress, so there's big disemployment happening in some manufacturing industries, and maybe there's some expansion in other areas of the firm. I guess my question is, how reasonable is this assumption? So I guess in this period, we're seeing, for example, if you've got a US M&E in some parts of the world, like the US, it might be shedding labor and the wage bill might be shrinking within the US activity. Whereas maybe if they're, cheaper workers in Brazil or something, they might be expanding employment in the middle income country. And so how do we, I guess one is if we assume that all aspects of the firm were doing the same activity, is this reasonable? But then if we think about like a big multinational that maybe actually does have a division that's selling insurance versus it's, making tires.
Yeah.
What are the limits? Because I guess you could probably bound these adjustments as well under alternative assumptions or something.
Yeah. Good. So, I see kind of two parts to your question that are interesting. So the first one is maybe something about like a dynamic adjustment. As you're saying, if some firms are shrinking, some firms are growing. Yeah, we've sort of the math and everything here is a very kind of steady state sort of idea, which is, sort of the best we could do at the moment. But yeah, the idea that, especially if you think there are, adjustment costs and things like this, and so firms aren't instantly transitioning to these different sizes or different kind of makes, would change because it would change the sort of optimality conditions. There'd be wedges in things, and so that could matter if that's important. So that's something that we've never really thought about that, in fact. But that's, to the extent that there's and there is this large literature on kind of wedges and dispersion in marginal products, we'd have to try to maybe figure out a way you could maybe use that to think about how things are changing over time. If all those things are constant, we're okay. But if they're moving over time, that would matter. And then the second thing, I'm thinking about the bound. So the sort of in our simple kind of theoretic setup, where we think things are kind of, suppose things are Cobb-Douglas, then what matters within the firm, and you're saying some firms are doing different things. Yeah. So what would matter for us, the assumptions that would sort of make a difference, what we're doing are the factor shares, the coefficients in the Cobb-Douglas reduction function. If those differ across firms, which obviously in the real world, they certainly do. Like you said, you have maybe some firm that uses a very capital intensive and some firm that uses a very labor intensive production process. That would sort of matter. And then markups. So if the kind of firm level markups, if there's a lot of dispersion of those within the firm, across firms is fine, right? Each firm is sort of handled separately. So different multinationals can have different structures and different markups and things like that. But within the firm, the assumption here that would make this sort of work exactly correct relative to the theoretical construct is that markups and kind of factor shares are the same. And so if they're not, so if you think, for example, that a US parent firm has a higher than kind of average, weighted average within the firm markup, then we're going to underestimate the amount of profit that should be reattributed to them. So, so you sort of, depending on whether a firm has a higher, whether an entity within a multinational has a higher or lower than average kind of markup adjusted for its factor shares would make a difference. And so that's something that we don't have a good way or we haven't come up with yet a good way to kind of think about robustness to. We can compute some factor shares, I guess. Actually, we could do the factor share part. The markup stuff is going to be much harder, and it's probably is probably something that's important, but that I'm just not sure we have something to say about yet.
Okay. Well, I think we're now over past 1:30, so or past 7:30 in the morning in Wisconsin. So
very good.
Thanks everyone, with some virtual applause for Kim.
Absolutely, this was fun.
Talk. Okay, and thanks for all the great questions. We'll see you, I believe, in 2 weeks. We'll be having our next ESCoE measurement webinar. Okay, so I'll say goodbye.
Great, everybody. All right, thank you, everyone.